Thank you for being on this video with me. My name is Rodney Constable. I am the president and founder of Simple Market Signals at simplemarketsignals.com. Simple Market Signals helps you minimize your losses and keep more of your profits through our proprietary market signals that are emailed to you every weekend. Today we will be doing technical analysis on the S&P 500 for Thursday, March 12th, 2020. And for this analysis, we will be using stockcharts.com. That is the charting service that I use and pay for, and I will leave a link to their site in the description box below this video. First off, I want to point out that we were down 9.51% today, and the S&P 500 closed at 2,480.64. And you can see here in the lower right-hand corner, we closed at the lows of the session. And this is a 3-day chart where each candlestick represents 5 minutes of trading in the S&P 500. And been using this chart for the last couple of days, so I just wanted to kind of continue and start with this one. But you can see here on Tuesday, and you may remember it was the same thing on Monday, we had been testing this 2735 level on the S&P 500, and then we cracked it yesterday, went down and kissed this level right here just below the 2710 area on the S&P 500. And you may remember that I've been telling you that any close beneath 2708.94 means we're in a bear market. Well, we rallied up and closed above that 2735 level yesterday. Then, again, more negative news about the coronavirus, the oil situation, and now the bond markets came out, and we gapped down today. And you can see we had a lot of volatility, and there was some Fed stimulus that came out during the middle of the day. And I haven't had a chance to do a ton of research on that, but what I do know is it was really not aimed at the coronavirus so much as it was aimed at the bond market, which even the Treasury market was having an illiquidity event. So that's where that stimulus came from. And of course, there was a short-term rally on that for about 15 minutes, as you see here, with each 5-minute candle going up. And then once it came out that it was really aimed at the Treasury market, and it was because the Treasury market was seizing up, is my understanding. Then, of course, we sold off for the balance of the afternoon and closed at the lows of the session. And to give you even more perspective on how volatile today was, this is a 1-day, 1-minute chart. So each candlestick represents 1 minute of trading in the S&P 500. And you can see here we gapped down at the open and traded lower. That Treasury stimulus came out. People thought, hey, great, more stimulus. But the high of that wore off pretty quickly, and we closed literally, and this is, again, each candlestick is 1 minute. So you can see that we literally closed at the lows of the session. And again, closing at 2478.86, 2478.86. So what does this mean for tomorrow? Look, oftentimes, as I said yesterday, and up till today, we've had 2 really bad days in a row here, but we had been saying one up day, one down day, one up day, one down day pretty consistently for the last couple of weeks. So it wouldn't surprise me to see some kind of a rebound tomorrow just based on those normal actions and the fact that we're down over 9.5% today. It would be somewhat normal to see a little bit of a pop in trading tomorrow. However, Fridays are oftentimes down days, and there's so much uncertainty around the coronavirus, the oil markets, now the bond market, that it's hard to say, guys. It's hard to say. In the short term, could we pop for a day or two? Yes. But with that said, there's no way that this downturn is over based on my experience and what we know and don't know. There's still so much uncertainty. There's still so much we don't know. So, guys, to think it can't get worse from here, I think is to be really naive. And, this could end up being far worse than most people realize. The market could go down a lot more than people realize. And it's still not too late to protect your capital, is what I'm trying to say here. And what we're looking at now is a 3.5-year chart where each candlestick represents 1 week of trading in the S&P 500. And as you can see, so far this week, and it's only been 4 days, this has been a very, very bad week. And, we've now fallen beneath all the major supports. We're well into a bear market. Again, anything over 2,700, as I've been telling you, is a bear market. That's why I had this line there. So we're now well into a bear market. And just for review, a bear market means you're down at least 20% from your all-time high. The all-time high was put in back on February 19th at 3386.15. And by the way, this is now the fastest bear market we have ever had, ever in the stock market, meaning that from peak to at least a 20% sell-off, this happened faster than any other sell-off that ultimately ended in a bear market ever. This is the fastest ever. So this is an atypical, not typical, atypical situation that we're in. And so to some degree, trying to use historical bear markets, in my opinion, to judge what may happen here, I think it may be giving us false hopes. Guys, I am not prone to being negative. I'm one of the most bullish, optimistic, opportunity-seeking individuals you will ever meet in your life. However, I'm also a realist, and the reality is here that we've got a perfect storm, okay? We've got the coronavirus, we've got oil markets where oil is priced below where most countries can profitably produce a barrel of oil. I looked it up this morning in preparation for this video for you, and most all countries around the globe, and I would encourage you to go out and do the research yourself so you own this information, but most countries around the world need at least $50 oil just to break even. In other words, that's their break-even cost, and that's not even including their social stimulus, okay, where a lot of countries have a lot of programs for their people where, social programs that raises up their budget, right, where maybe they need $95 or $100 oil in order to balance their budget. So at $50 per barrel, and we're about 35, I think, right now, we're well below the 50 number. I think we're around 35 on West Texas Intermediate crude. What that means is there's a lot of pain in the oil countries, which means it's going to hurt their debt, which means it's going to hurt their currencies. And, and then you look at states, Texas, Colorado come to mind as just a couple of states in the United States that produce a lot of oil or shale. And we've got all of this going on at the same time. And now, and I've been warning people for years, but most recently on my videos, in the last few weeks, about the dangers of the bond market. I feel that the bond market is by far the most dangerous area in financial investing. The pain that the bond market could inflict on us is possibly far worse than what we're going to see here in the stock market. So I'm not trying to be overly dramatic, guys, but I'm telling you, there's some bad things going on here. And to think that it can't get worse and that it won't get worse from here, I think is to be, I think if that's the opinion that one has, I think we're ignoring the facts, we're ignoring the data, and we're turning a blind eye to the realities of where we're at right now, okay? So, again, as I've been telling you over the last few weeks, 2350 minimum to the downside. Guys, we're at 2480. I mean, all we've got to do is go down another 130 points and we're there. So, that's pretty much a foregone conclusion, right? We could easily hit that even tomorrow if we have a bad day in the markets tomorrow. And at 2350, you can see that now, okay, again, this vertical line is 2018. At 2350, we're now back into April trading in 2017. So what I'm saying here is if we drop down to the 2350 level, and I think we're going there and then lower, then, we've erased all of our forward progress in the stock market from March, April of 2017 to current, okay? So we've lost now about 3 years of gains, 3 years of profits. That's very discouraging. And just so you understand, I think now that we're so close and this has gone down to towards this 2350 level, which again, I would be surprised. As you can see here, that's the level we started this rally, right? Where we kissed that area. That's where we bottomed around the 2350 area at the end of 2018. Here's that bull market that we had. We're now in a bear market, first bear market that we've had, which again, 20% or more correction. This is the first time since March 9th of 2009 that this has happened. So that, that bull run that we had is dead. The bull market is dead. We're now in a bear market, and bear markets last months and months and months, if not longer. Okay, so this is not a couple of week process, and we're going to be out of this thing. And so once we break this 2350 level to the downside, and you can see there's just not a lot of support there. There is some, but not much at all. And so that takes us down to at least this 2100 level in the S&P 500, okay? I am not trying to scare you. I'm trying to educate you. And guys, I'm telling you, it could get worse than that. So, right now, the way it looks, maybe it'll be a few days or another week before we breach this 2350 to the downside. But from there, I think we very rapidly, because you can see there's just not a lot of support, I think we very rapidly get down to this 2100 level, and maybe even further, a little bit further down. We should find, more and more support once we get down beneath that 2100 level. But let's throw a line in here towards the bottom of this range, so you can see that, let's call it, just for round numbers, let's call it 1900, and there'll be, again, support around the 2000 level. Round numbers, as you've heard me say, oftentimes provide support psychologically or otherwise. So I think that, we'll hit this 2350 level. There might be a little bit of resistance to the downside there, but then we're going to this 2100 level, and then probably 2000 from there. And again, guys, to think that it can't get worse than that it means that we're ignoring the facts and we're not paying attention to the realities of this situation. So it's not too late to protect your capital and keep yourself from going down any further than what you already have, if indeed you haven't trimmed profits. And again, this is where Simple Market Signals can help you in my market signals, because I've got two components in this. I've got a risk-based component and I've got a trend component. And guys, it flat works, okay? And again, it's less than $20 a month. You get signals at least once a week, if not more often, emailed to you. And I want to show you here, we're going to go out to my YouTube channel, the Rodney E. Constable Success Channel. And I want to show you a few videos that you're going to want to watch so you can really understand the power of Simple Market Signals and how it can help you in these types of really bad markets. So, and each one of these videos is less than 5 minutes, okay? So you'll need to invest maybe 15, 20 minutes in your own education to see how this works and why this is so special, and why financial advisors use this to help run their practice. And even if you're really good at technical analysis, this goes way beyond technical analysis. But I called it simple because it is simple and it's easy. And even a novice, even if you're brand new to investing, you can use these signals, okay? So to find out more about it, though, a couple of videos, and I will leave a link to these videos, by the way, in the description box below this video. But just so you understand, when you go out to the channel, S&P 500 2000 through 03 using Simple Market Signals. This will walk you through the charts and how Simple Market Signals would have worked there. And also 2007 through 09. So these were both bear markets and really, really bad markets. And you'll see exactly how Simple Market Signals could have saved you a lot of pain and a lot of money during those downturns. And then also 2018 was another bad year in the markets. The S&P 500 was actually negative, but you could have easily had a very nice little profit in 2018 by using Simple Market Signals. Okay, you had a nice little profit without a lot of, and you would have only been invested, like a third of the year, and you still could have come out with a profit, where buy and hold investors were negative in 2018. Now, so those three videos will really help. And again, I'll leave the link to these videos in the description box. But then if you want an even longer explanation, Introducing Simple Market Signals is a video that you're going to want to watch, a little over half an hour long. And again, the link will be in the description box. And if you want the full story, if you want my background, if you want the full story of Simple Market Signals, then Successful Investor Webinar. It's about an hour long. Guys, you're going to learn so much about so many aspects of the stock market. I get into the bond market and why it's not going to be in a position to help you going forward like it used to in the past. We've got problems all over, and I'm telling you, to be a successful investor going forward, guys, you need a loss-cutting strategy. You need a risk management strategy, which is exactly what Simple Market Signals is. And I have priced this thing as low as I possibly can so that the vast majority of people that want it can afford it. It's less than $20 a month. And I'm telling you, it's costing you money not to subscribe to that newsletter. So I'm not trying to be overly dramatic, guys, but just look at what's happened. You know, go back and watch my videos over the last couple of weeks. You'll see what I'm talking about here, okay? And if you haven't already subscribed to my YouTube channel, please do so. Give me a thumbs up on this video, and I look forward to seeing you tomorrow.